ESG investments usually get high remarks just because of what they're not. They're not oil stocks, they're not energy, they're not industrials, typically speaking. They're not typically smokestack companies. They're not coal miners, obviously. They're not any kind of miner. So that is really what makes an ESG investment what it is by looking at what it's not. So what happens is if you take a look at what's included in ESG, after you get out of smokestack type companies, a lot of the economically sensitive stocks like energy stocks, then you move into companies that are either in technology or finance, companies that don't really get their hands dirty, companies that don't make things that if you drop what they make on your foot, it'll hurt. So ESG has a very heavy bent toward high technology, so tech, and then a lot of innovation type companies. And you might think, well, innovation is great. That's where you get the growth from, except that you also have to know that typically speaking, a lot of innovation companies are the highest priced, most richly valued stocks often. And these are also the ones that if they miss on earnings or if they miss on a patent or if they miss on a new product, these are the stocks that often could get hit the hardest as well. So you have to take the good with the bad, but that is often a place of high potential gains, but high potential loss.